fantastic day, and I hope you all have the opportunity to engage in some valuable networking with your fellow attendees as well. The session on mobilizing capital for India's energy transition is co-curated by Dalberg Advisors and Impact Investors Council. As we deliberate and understand the investment opportunities emerging across India's green transformation journey, one question in the minds of most capital providers is, how does one really create a green financing strategy? How can our funds be optimally deployed? The India Mid-Cap Energy Transition Index, structured by Dalberg Advisors, aims to address just this. This index is a relevant investment tool for India with the potential to guide capital allocation beyond just large, renewable energy focused Indian companies. It places a special emphasis on the mid-cap enterprises and those in the hard-to-abate sectors. During this session, our goal is to bring together perspectives from industry experts and practitioners to build a robust framework that can support the development of an India-specific and climate-focused investment strategy and portfolio. Without a further ado, allow me to take a moment to introduce our distinguished panel of experts who will help us understand how a framework or an index can drive capital towards India's energy transition. On the panel, we have Anna Biswas, Managing Director India at Forum for the Future, Ravneet Mann, Head of Policy and Strategy, Stride Ventures, Ramraj Pai, a financial markets and social finance professional, Shashank Avasti, co-founder at Ally Venture Capital, Suresh Goel, MD and CEO, National Highways Infra Investment Managers, Vikram Dileepan, Principal at Low Capital, and Vivek Sen, Associate Director, Climate Policy Initiative. Last but certainly not the least, we have our esteemed moderators for this discussion from the team at Dalberg Advisors. We have Tushar Thakkar, Associate Partner, and Jagjit Sarin, Principal and Global Co-Lead, Global Climate Practice at Dalberg Advisors. Now I would request Devaki to come onto the podium and for the presentation.
Thank you. I'll keep this short. But over the past couple of months, we've been working on thinking alongside the climate investment funds at the World Bank about an India-focused energy transition index. As everyone in this room is probably aware, India's emissions targets require significant amounts of additional financing over the next 10, 15, and 20 years. And as we were working with the World Bank, we realized that a credible and well-designed energy transition index could potentially not just mobilize international and domestic capital, but also significantly catalyze a lot of innovative approaches that are already happening in India and expand capital flows to currently significantly underserved sectors, chief amongst which are what we traditionally consider hard-to-abate sectors like steel, chemicals, etc. So as part of a rapid landscaping exercise that we conducted over the past few weeks and months, we looked at several key indices in the space, and my bad. And we noticed that there were some explicit and implicit gaps in coverage, in inclusion criteria and exclusion criteria. Sometimes the gaps were unintentional, but overall, even when Indian companies are eligible to be included within an index, we saw that very, very few global indices cover them at all. And by cover them at all, we mean even a single Indian company, right? And even when they cover an Indian company, this is typically one of 2, 3, 4 really large cap Indian companies. So your Infosys, your Reliance, things like that. And then when we look at sectors covered by these indices, we see that globally, when you say green index, renewable energy sectors are reasonably well covered. But in India, because most green indices tend to be ESG indices, the skew is very heavily towards financiers and FMCG, consumer goods companies. And of course, hard-to-abate sectors are a gap across. And then finally, we realized that when we think about criteria to include a company or to rate a company on a green index. Most most indices use criteria that don't look at commitments. And that means that traditionally non-green sectors and companies in those sectors find it very hard to tap into funding for a transition that they desperately need. So, um, so we'll pause there. We think there's a lot of potential for such an index, and we have thoughts about the priorities of such an index and where it should be focused. But we'd love to hear from our esteemed panelists, and I know Dishant and Chakjeet have a lot of specific questions into how we can maximize the impact and maximize uptake and really use an index of this sort to drive capital flows to catalyze India's transition. So over to you.
Fantastic. Thank you, Lindsay. So that was just to set some context on the conversation. Thank you everyone for joining in. What we'll do over the next 35 to 40 minutes or so is actually based on this context, maybe go through, we have a fairly, widely experienced diverse panel here. Go through a set of questions, both around the practicality of an index of this kind, what should be the design principles that we should be considering, and finally, is this, even if such an index were to come about, is it going to be beneficial for investors? Is it going to actually support or help companies? Are the right companies going to get the money? So these are the kind of questions that we wanted to touch upon. What we'll do is we'll spend the next about 30 minutes or so just going around the table. We have a set of prepared questions that I'll run through, and then we'll open it up to the audience for questions. Fantastic. Maybe I'll start with you, Vivek. Given your vantage point, you have seen the ecosystem of climate finance, and your organization also writes quite a bit about how the policy environment, the ecosystem could be shaped to bring in the lot more finance that needed for the transition from abatement, etc. When you think about an index of this kind, and especially as one of the things that we ran into significantly was this challenge around the practicality, especially when you think about a market-linked index of this kind. So maybe to get your thoughts around the practicality of it, how can something of this kind be brought about, and of course, the broader thoughts around, is this relevant, useful?
Yeah, thanks, Tushar. To be very honest, it is a indice that can be done. It is doable, and also considering the spread of energy transition that we have and the market actors that we would be needing to channelize and utilize the capital into projects that eventually can facilitate energy transition. Yes, this is very much doable, and there have been examples in past. NSE and BSE have CarbonX and GreenX, the two indexes that are sort of sustainability linked or can be called climate aligned. But overall, we have to keep in mind three important questions, and this is necessary from the context of what the indice is trying to do, whether it would be able to achieve its objectives. So the first thing is, does the market need such an index? That's the question. Secondly, if there is an index, then would it be able to channelize capital into green projects or climate aligned projects? And third, you may say that whether large institutional investors or patient investors like the pension funds would be allowed to invest into such indices, because typically they do invest into large cap companies and they act as quasi-institutional investors in most of the cases. So those are the three questions that we need to ponder upon. So the key is that if such an to happen, then there are probably ABC that needs to be followed or should happen. The first is that the focus should not be on market capitalization or on climate, but rather a mix of both. So it has to be investment with purpose. It cannot be just for or profit with purpose. Rather, it cannot be just for profit or cannot be just for purpose. Because if either of it happens, then it will drive out the investors. That's number one. So the investments or the companies that are there in this mid-cap index should have a transition plan or a, you can say, mitigation plan in place, which should be available to the ultimate investors who will take position in this, such a index. The second is whether large investors actually start investing into it. Probably the regulators of, say, if we are talking about pension funds, probably PFRDA will have to allow it to happen, right? So the regulators will have to amend their positions or probably modify their position. And third is how to attract the requisite amount of sort of capital or interest from the investors into such an index. Now that means that this index should have a very focused view wherein it is concentrating on a slew of companies which have a definitive project pipeline, right? So all that should be visible to the market, and that's only happening, and that is the only way you would be able to sort of mainstream such a index in the country. Why I'm saying so? Because India is a very active, I would say, investment market when it comes to investments, and it is unlike Western countries where mostly the investment managers operate on your behalf. Here, the investors take active interest and they manage their own funds. So indices will generally offer you muted returns as compared to the Western countries, right? Now, that's the exact problem that needs to get solved, and probably in the initial stages, we should allow foreign institutional investors to take position into this index, right? So that's to kickstart the index, and then the 3 points I mentioned to sustain the index in the long term.
Thank you. Thanks a lot, Vivek. I think that sets the framework really nicely. It raises a few important questions around what practically needs to happen for an index of this kind to actually hit the ground. Maybe staying at the ecosystem for a bit and to supplement what you said about how the financial ecosystem needs to evolve, and maybe invite Anna to share her views. And I know we've worked together on it, and you've spent a fair bit of time pushing financial, not just to think about this from, to think about this holistically, to go beyond just the E, and even though ESG is fairly limiting in that sense, but to go beyond that particular aspect, and to use some of this opportunity to build a more just world. So, are there ways in which the design of this can be tailored so that we can actually?
Thanks, Tisha. Yes, I think so. Which is good news. I think it's important not to ask too much of an index and to realize where the boundaries are, but I do think even within those boundaries there are definitely possibilities for this. I think in order to do so, to be able to not just encourage an energy transition to a low carbon energy system, but also a just, or in this context, maybe people-centered is a better word, because justice is a bit too close to that word here. But a people-centered energy transition, I think there are ways in which we can do that. The first and probably most obvious is to make sure that you're looking at, to your point, not just environment, not just climate, but also business profitability market cap, but also the social side of things. Traditionally, indices have not been great at integrating social factors into it. It feels a little bit more woolly than the more tangible environmental impacts to look at, particularly if you're just looking at climate. But in this case, I think we have not got the time to get ourselves to a low carbon energy sector and then go, oh, but we need a positive social outcomes as well. We have to do that at the same time, so something like this needs to be able to drive both. You can do that. You can, now there's a much more sophisticated set of measures you can use to relatively simply understand whether or not social outcomes are being driven in an index like this. I think secondly, we need to make sure that this is outcome orientated as well as process. A lot of indices, a lot of, even just a lot of boards are for processes that corporates put in place. They're not necessarily whether or not those processes realize the outcomes in the real world afterwards. So that's hard. It's not always as easy. It's much easier to say, well, have you got an environmental management system? Do you have a policy on human rights? Than it is to say, well, actually, are you having positive ecological impacts and including that in your assessment index or a standard? That's why the standards are all process standards and not. But there are ways being developed, and I think there are also ways being developed that make sure that you put the corporate in its context. It's not just its own operations; it's a value chain, and that value chain also has impacts. And now, the understanding of climate internationally has gone from scope 1 to scope 2 to scope 3, and people are really battling with what scope 3 really means. But even now, scope 4. The IT industry is fantastic at being able to say we're allowing these emissions to be avoided by the work that we're doing. So if you can be looking at the environment side of things, the social side of things, with that whole value chain and more sort of systems-orientated approach, I think you're going to be encouraging that just transition, people-centered transition to low carbon energy. I think the point about outcome and process, I think there are a couple of things, a couple of buckets that are useful to bear in mind. In terms of outcomes, you could have an index that just encourages you to reduce the emissions, to mitigate your own emissions in your own scope 1. You could go into the other scopes as well. But if you're really going to push the boundaries on sort of people-centered transition, you need to be looking at not just whether social environmental systems are thriving because of what these companies are doing, but also whether or not you're seeing the outcomes in the real world. So, is planetary health actually stabilizing? Are human rights being universally respected? Are there fairer ways to create and distribute value in the supply chain? And actually, are you seeing resilience and vitality being brought about across generations, across geographies? These are big, lofty goals that we need to be working towards. An index cannot do that all, but what it can do is align yourself with that and not cut off the chance, and not just kind of say, well, actually, our ambition is just scope 1 climate. So I think, and then one last point on the process, I think if you go to Marjorie Kelly's understanding, which is brilliant, of how you have systemic impact, at the corporate level, if you look at purpose, your ownership, your financing, your governance, and your networks, if it's aligned to the people's principles of a people-centered transition to renewable energy, then those 5 things are really useful signs to use in an index.
Thanks, and I think, thank you for that. I think that sort of really helps both think about how we can deepen the impact out of something of this kind to add to how do we even think about getting something like this on the ground. So maybe moving from sort of the ecosystem level framing or the objective outcomes level framing and going to how capital for someone that's regularly raising capital might think about inspiration. Maybe I'll come to you next. Do you? I mean, of course, you now work at the NHI Investment Trust, but you've in the past managed funds, worked in helping clients of these kinds to actually raise capital as well. How do you see this? How do you see the effectiveness of something like this? Is this, and also what, as someone who is in the market, usually also looking for additional capital for your operations, what would you like to see in the design of an index of this kind? And do you think that one of the hypotheses that we went in with as we were thinking about our work was that if we are able to influence financials to reallocate capital, that acts as an incentive. Does that resonate? Does that work in the real world?
First of all, Tushar, my dear friend, thank you for inviting me. I'm honestly feeling a little out of place here. So I am a student of infrastructure, not really of climate finance as such. And I'm just reflecting on the comments made by my esteemed panelists, Anna and Vivek here. The way perhaps, and pardon my ignorance with regard to, you did brief me about this, but since this is not my subject, so pardon my ignorance here. The way I would look at this is in three parts. Number one, is there a need for an index? Absolutely. Because, I mean, I personally also believe in the dictum that whatever can be measured can be improved. As simple as that, right? So we need to have something to be able to measure. So that's point number one. Point number two comes about is, there are two sides of the equation. There's the capital provider side and there's the capital taker side. Now, I think capital providers are already converts, right? They have allocated capital, they are looking for ways and opportunities to put capital. But then comes out the other side is, how can they determine where to put capital and how to evaluate the opportunity, given that they have limited resources to evaluate an investment opportunity, right? So there's a need for always an index or a benchmark, whichever way you look at it. So there's a tick there. But then you come to the other side of the equation, which is the capital takers. And since we are talking about mid-cap scale, so we need to, a lot of things there, and you talked about IT. Now I think the way perhaps we should look at it is, if we have to make an impact through this index, then we need to look for industries which are energy intensive. By very nature of them, they end up being heavy engineering, fabrication, transportation, logistics, and the works, right? So since I understand infrastructure quite well, I can perhaps comment on that a little more, but notwithstanding that, I think we need to define this when we are doing the index as to what would that index consist of, so that there's some sort of uniformity we can do. Because if we try to club infrastructure with process industry and this clubbing process industry together, then we might not be able to do justice, because the basis, the outcomes, the timelines are all kind of different. Process industry would require a lot of capex investments to happen for it to become energy efficient, whereas transportation or infrastructure may require more process changes for it to become more energy efficient, right? So that's the second criteria that we need to think about when we define it. The third one is, based on my experience with capital providers, investors and all that stuff, for them to have confidence in this index, they need to be able to say, yes, I trust this index. And by very nature, when you bring in that concept, that means there's got to be an institution, whether it's Dalberg, Bristol, S&P, somebody, who's got to stand behind that index. That I stand behind this index as the data that has gone into this is accurate, has been diligenced, and I will keep confirming updation of this at periodic intervals over none of this financing is going to be for 6 months, 1 year or so. We are talking about long term. If you are really talking about transformational, that means somebody's got to say that I'm going to be supporting this index
including collecting data, despite how they will get remunerated is something we need to think about, at least for a 5-year period or more. Because any of this financing would be to the tune of at least 5, if not more. So I think these are the 3 high-level points that come to my mind when we talk about design. Right? But I do think that if the approach is broke this brought into a certain framework, maybe then collective wisdom would travel so fast. Thank you.
Thank you, Suresh. I think it's really important point, and I think what you brought in is that this not only one, of course, is a long-term nature, and someone, as you said, someone credible needing to stand behind it, but also to think more broadly about what are the roles of all kinds of not just the capital recipients or the providers, but also about the surrounding sort of financial ecosystem. Actually, just going to jump the queue a little bit, that I had in my mind, and we go to Ramraj next, because we had a conversation, Ramraj, earlier, and I hear echoes of some of the conversation that we had in what Suresh said as well. You of course, worked in the rating space. You've seen the other side of it with the Impact Investors Council, and now advising a number of sort of blended funders. I want to get your perspective around maybe carrying on from what Suresh was saying. How do we think about how can we think about really implementing this in a manner that this really creates the value that we want it to, right? I think how do we make sure that this is focused at the right places so that we can get the impact that we spoke about, but also the practicality, I think, of solution.
Yeah, so I think there are broadly 2-3 things which are important here. One is the empirical proof that an index of this nature will give some kind of return, which presumably at least is a market return, if hopefully that is important. Right now, whether we have evidence of that or not itself could be up for question. For somebody to tell me that ICICI or Infosys is very high on their ESG or emission standards is fundamentally a function of what their industry is. It's despite them, not because of them. That is the nature of their industry. If you are really looking at this as something that is going to support genuinely a transition, focus has to be on the very difficult industries which account for a disproportionate share of emissions. One. Secondly, when we look at these extremely, if I may say, heavy sort of polluting industries, even a small delta that they will hopefully capture should get a disproportionate share in terms of their performance. So for example, just to give an example, in my earlier answer at some point we were flirting with this whole idea of education gradings, where we are grading colleges, business schools and so on and so forth. And so one of my professors said that, okay, you've done all this grading, and we obviously came up with IIM Ahmedabad as the best. So he said, what is IIM Ahmedabad doing? Basically taking the best students and adding a bit of a delta, and then giving them hopefully even better jobs. What really the function of that grading should be to take a college which should be, say, below average or at best average, but converting them into somewhat above average students is the maximum delta to the ecosystem. In my view, an index like this has to be able to do something similar, which is looking at incremental improvements of sectors which are difficult to fix, and attracting capital for such companies is what this index should be doing. The question is, the fact that you will create this kind of mitigation effort, will it necessarily translate into better returns? The jury is out on that. We have no clue. They may do a fantastic job, okay, but possibly they are not going to be able to generate better returns. So this is a fundamental sort of an issue, and therefore something like this needs, at least in the beginning, maybe over a longer period of time because of all the ESG risks they will, but in the initial period it's not. So this will need a lot of government support. This will need government institutions or government capital in some form backing it, evangelizing it, pushing this agenda. Because the fundamental construct that I have seen in ESG is somewhere there is an industry risk or an industry emission potential, and everything is sort of in and around that kind of a score. So steel will have a score, cement will have a score, IT will have a score. But really, if we are trying to push structural change, then we will have to essentially look at something which is creating an incremental delta, and you will have to create some kind of institutional funding ecosystem which will, at least in the initial days, push this. And effectively what this will lead to at some point of time is some kind of emission rating or an emission score which is relative to the industry and not an absolute. And I feel that is structurally where a lot of the existing things which are going wrong, which is looking at absolute, because it really doesn't matter that Infosys went from 99.5 to 99.8, but if Tata Steel went from 30 to 40, you've really done something very, very significant. So I think the returns is something which is nebulous, and I think the methodology has to be structured towards incremental improvement relative to the industry of, say, the top 5 hard-to-abate sectors. So to me, the fundamental building blocks are going to be these two: institutional support from an ecosystem level and an index which will measure relative benchmark within, rather than on an absolute level, because on an absolute things will look good, but they would have looked good even without your index. You don't need the index for that. If you're trying to prod the system into something, you have to support the guys who are really trying to run with one leg, rather than trying to support the guys who've already been training for the Olympics for the last 20 years.
Thank you. Fantastic. I think that I think carries on really nicely from what Suresh said, and thanks, Rahul. I think that also provides great food for thought as we think about how we even design this, right? I mean, where are we even going to get capital, how we think about risk within that, and as you started by saying, right, how do we think about sort of almost phasing this so that we are initially also factoring in what investors are looking for, but where the market is and how we push them to go beyond where they are at this point of time. I'll maybe come over to Shashank. Shashank, you worn a number of different hats. You've been a commercial banker, you've been an investor, you have been a fairly sort of passionate about distributed rights. From your perspective, hearing what we've heard from all of the participants here, how do you see this really happening, especially when you put on your funding hat, but also as you think about intersection?
Thanks. I just build a little bit on what Ramraj and Suresh were saying, and I'll say that I speak like an asset manager who runs a portfolio of assets on an everyday basis. Let's say I'm a loan products guy, or at a fixed income, or at an equity, or whatever. Right? I have some time for this conversation, but only a little bit, because I got to run my portfolio. How does my portfolio really run? It looks for discovery. That's what indexes do. It allows me to be able to very quickly scan and say, here's where I can go. Indexes tend to gain a reputation for returns, but that's something that the index and their performers generate for themselves. So usually, the first thing it does is, it indicates to you that here's a market that I can go after easily. So how do you really allocate capital to, let's say, climate changing activities? Because somebody like yourself will come up and say, we are going to do this group. I'm simply going to trust it. Right? Like we did with rating companies with all their problems and whatever. I'm going to trust it, and then I'm going to come and say, the guy who runs my book, saying, you're good to go. I think that's really where the problem is. At all boards, everybody is shaking their head and saying, we've got to do something about climate change. Who's the guy who pushes the button to make the dollars move? The guy on the desk. He doesn't know where to go. Right? Because if you show him something to climate change, oh, it sounds nice, but my mandate is ABC. Is there an index? Is there whatever? The second order effect of an index is, for example, 70 years ago, 70, 80 years ago, if you wanted to do anything with municipal bonds in the US, then the only reason it works is because Solomon Brothers stood there and said, I will buy and do whatever you want. Right? So there was a discovery process, and that brought in somebody who said, I'm going to go after this market, and I'm going to be the axe, so to say, which means I'm the market maker, you can come buy, sell, do whatever you want. Right? I think that then starts to bring in a lot of other people, because you've saved them the time that it takes for discovery. You've given them this particular thing about exit. Right? At some point in time, I want to be able to see liquidity. Right? So I think these are the functions of the index. I don't worry about returns being projected. I also will take it with a pinch of salt, right? Because we've all seen, I mean, we all predict whatever returns we make and things like that. So I think that's a very important point. The other thing that I want to say is, I think we're talking a lot about, she talked about resilience and we're talking about mitigating climate risk or whatever. But climate risk is going to show itself up as a crisis, right? We're in the middle of that in this room today because of what's happening. Our design systems are very, very poor. My work with disability inclusion shows consistently that we are designing only for a limited set of people operating in a very limited environment. Both of those go for a sixth the moment a crisis hits. Like happened in COVID, for example, across all the countries, all over the world. It happened in Katrina, wherever you are. So I think what really stands, I don't do climate finance work that much or whatever, right? But what's surprising to me is how little conversation there is around the preparedness of when the risk is going to come. The risk is here, it's at our doorstep, we really don't know what to do with it. If you see today, your ability to physically run fast on the street is limited because of what's happening in the air. Okay? We haven't built our systems for that. And I think the B2C elements, therefore, let's just go back to the asset manager. I'm saying that anything that touches the individual is significantly off from what we will need in the moment of crisis, which is where climate risk will show itself. So these are two very different points.
Fantastic, thank you. Thank you, and I think very diverse perspective, and I think the point that you brought up at the beginning, I would have come right after you for that. You spoke about as an asset manager, and I think the perspective that you brought into you speak about how you would think about this as one part of your portfolio, and therefore what you are looking for is basically credibility. To be able to say that okay, this index, as you said, gives me discoverability. It tells me that there's a particular kind of an asset out there. If it fits in within my thesis, then this index lets me invest in it, right? Because the reason why I wanted to get your perspective here was because one of the things that your firm has done over a period of time is really take a data-driven approach when you think about your investments, about measuring what your investments do, as really sort of the impact investing, right? How do we bring about or get the credibility that Prashant is talking about? How do you
Sure. So first of all, thanks for inviting me here. It's my pleasure to be among the esteemed panelists. I'm going to take a few pages of the passages that was just given to me by Suresh and Vivek and Shashank. But essentially the way I see it, and this comes from a context of my entrepreneurial journey, bordering a little bit on climate finance and infrastructure. I used to run a solar energy platform. And for the past few years, I've been investing from low capital leading climate here. And essentially, climate is the category leader in impact, right? But that being said, there are umpteen number of frameworks out there for capital allocators to request the GPs to stick to. And some of these sampling might be your TCFD or SFDR, and there are also proprietary climate frameworks. But all that being done, there is still not a way to very credibly measure, monitor, and categorically and emphatically say that this is not only reducing emissions but also producing commercial returns. Because at the end of the day, impact investments are an asset class and they have to return capital for that asset class to continue to succeed and thrive and create impact in the ecosystem, right? So the question of a viability or a existence of such an index is out of the question. It needs to be there. But rather, I would say the bigger question is how do you go about creating this index in a way that capital allocators have a very clear guidepost to seeing how this impact is being created in scope 1, 2, 3, and perhaps measure it, and also very clearly articulate how this correlates to the commercial performance of both the capital provider as well as the investee. Because at the end of the day, this has to matter both to climate impact as well as to the bottom line. And that is the way to ensure sustainability of such an index. So that's my point of view.
Thank you. And finally, really for the last word, you of course work with. We spoke about mid caps. We spoke about companies which are growing and might not necessarily be in the sectors that receive a lot of transition funding. As an investor and as someone who works with these enterprises, how would they perceive this? Do you think this is valuable for the enterprises that you work with? Do you think this helps not only incentivize them to sort of think about climate transition, but also think about something like this as potentially helping their own sort of growth efforts and by sort of getting more capital, more social capital in this response. So,
Thanks, Vishal. I think very relevant question, and I'll just go back to what Vikram was saying and make it differently. He was saying we're looking at impact investment as an asset class. We're a venture debt fund. Venture debt as an asset class. What can it do to drive that impact investment? I don't need for a new asset class to really come up and take up. How can I bring in that agenda into my existing asset class? And maybe that is a function that can be facilitated through this sort of an exchange. I mean, we're looking at AR, we're looking at data science. It's really becoming prominent in objective decision making. When you're looking at how CIOs are increasing, asset, allocation, increasing financial support, they're trying to see whether there is an explicit linkage between an ESG objective and a financial performance. And if that can be measured and translated through such a medium, I think it gives that boost of confidence to be able to increase that amount, of allocation that you're really seeking. Even if you're looking at right now actionable insights in terms of climate impact, we are looking at evidence-based insights because it is an unforeseen scenario up until now. So this again would provide that precedent, from that perspective. And I think it's also, I just want to say that what you measure shows what is important to you. Up until now, 90% of reporting was, by regulatory bodies and governing policies required, it was 90% financial reporting. With the advancement in terms of that outlook to expand to ESG reporting, with the RSR coming in the previous panel I was listening to, we had the executive director from SEBI, Mr. Rao, talking about how they are inviting applications for ESG ratings as well. So, is it something to do, to go after? If the question is definitely a yes, the question mark that I have is how. To be done in a manner that is going to be able to provide that level of confidence and that credibility and that stamp of approval. And I think that brings me back to some of the questions that Mr. Pai was bringing up over here. And I think if that can be addressed, I think it's definitely a step in the right direction. The level of impact it can create will of course depend on that.
thank you very much. I think maybe we have a few minutes. I think we do. Yeah.
We are looking for votes, so 10.
10 minutes. Okay. We can open this up for questions from the audience. I think there are a couple of hands up there.
So assume in 80 energy transition index, mid-cap, all that is there. What beats me is as follows. Equity secondary markets. We are talking of returns, which is fun. Whether a fund manager allocates to index, India is not an index market, it's an active fund management, all of it is fine. But does the index create additional capital formation? Because if you're talking of returns, it's a secondary market. So I own the stock, you will own it. You'll be more demand with FPIs or more institutional investors. The price of stock will go up, index will give you equal or higher returns. Does it actually translate to higher climate finance? To my simple mind, it does not, because secondary equity markets do not contribute to climate finance irrespective of whatever flows we get, unless we are saying this is from an IPO of a company in which venture capital, private equity have invested and they're exiting into that index, and that's the index of the small companies getting into the index, and therefore that's new capital formation. Otherwise, index, great thing to have, allocations, muted returns or otherwise, all apart, but I don't see it creating incremental climate investment. Please explain, maybe, Jagjit. Yeah. Thanks.
Thank you. No, I think this is. I thought the professor was not allowed to ask questions.
He answered it somewhat when he said that if there's enough secondary, then obviously there's incentive for primary. Right? The more the secondary is going to be, the more the secondary is going to be. Like I'm saying, if I'm an asset manager and I cannot invest in this mid cap because it's not a part of my mandate. my junior partner mandate because my board needs to have either an index or some pass-through mechanism through which they can say, yes, go ahead and do it, right? So if I go into the second day, obviously that's going to start people getting excited about where their IPOs would follow. Yeah, of course. So there's going to be a market that's going to get created for IPOs. And I mean, that was your answers on this.
No, my answer explained by you because as confused in my head, it's not creating more capital anyway. So that's what I thought. But into leading on to the future, maybe you're right. It can.
Maybe I'll just maybe one more element and maybe also open it up to the other participants.
I just want to.
Yeah. We have a lot of answers here. Thank you.
Really does it. It is channelizing some of the capital that wouldn't have been used for climate aligned projects and put it there. And also in the process, some of the companies which were devoid of capital, say for example, I'm just taking an example, Monnet Ispat, mid-cap company, it is on its transition journey, it needs capital if it has serious plans, right? And it is struggling to get capital, and probably this index will help it reach to the potential investors who may want to finance its own transition journey, and thereby it is sort of helping create that ecosystem.
Yeah. So Tushar, I'm Sushmita, and have a more fundamental question. So if you look at the equity indices or the debt indices, you first needed to have the data. So you needed the Bhav copy of kind of, X years, you needed the script level valuation of the bonds. So in this particular case, the question is around data. How would you construct the index? Because she spoke about the fact that the criteria would be around commitments. And that is a data that is hard to get. Monnet Ispat really does not kind of, disclose that data. Tata Steel today does because of the BRSR regulations. So my question is, how would you get the data? No, it's around commitments.
But not a bond. Thanks for that question.
No, it's not a bond index, but I'm saying the data has to be first there for the index to be constructed. And also for the back testing, sorry. For anybody, an investor to use it, you need to kind of back test it minimum for 5 years to show that it kind of works under different scenarios. So that's the other practical problem around back testing.
Public, is there enough? So there are a couple of things which, to our mind, are forcing companies in that direction. One is, for the 1,000 companies, they're pushed by BRSR, whether it's broadly ESG, but climate is getting more pronounced, more at home. If you are in the supply chain, soon you're pushed for a scope 1, scope 2, scope 3, and if you're raising money from, you are again pushed by bankers. You looked at the banking ecosystem, people who are financing from the debt side or equity side, they are pushed by regulator RBI to say, okay, what is the transition risk? What is the fiscal risk? So the point I'm making is all parts of the ecosystem, from finance to your supply chain to producer to consumers, all are pushing you towards more commitments, more putting your commitments out there in public for scrutiny so that you get the credibility to raise more green capital and even just the capital. More and more, I think in coming years, carbon would be the currency where you would be measured irrespective of which industry you are. It would be more difficult for hard to bid sectors. To our mind, in the next couple of years, you would get to see these commitments more clearer, more in public domain, more scrutinized for the reasons of their compliance, but also for the reasons of raising money. So it's a work in progress. I agree it's not out there yet. We don't have the 5 years data to just make a track record, but it's in a way chicken and egg. You have to start somewhere.
Exactly, and it's a sequencing issue. Because the data needs to be there for at least 4 or 5 years minimum for us to build the index. So it's the data being there and then the index coming in after some point of time.
Yeah, no, absolutely. And maybe just to add to what Jagdeep said, I think we might need to think about, as Jagdeep said, in sequencing of this, do we think about this as not being listed in the traditional sense for a period of time, where you're actually able to inform capital allocation, but you might not necessarily listing this on the stock market, and then can you get the data? So I think we need to think a little bit more about that. I think it's at a phase where we've come with a framework, but I think that's an important input.
Yeah, only the sequencing part of it.
Absolutely.
Because any investor would need to look at back data.
Absolutely.
And the quality and the quality,
Standard taxonomy.
and the assurance, because people are going to put money on it. So Mr. Rao spoke about assurance. So kind of, is that assurance also kind of gold standard?
Absolutely.
Thank you.
Sure, I had a.
This maybe should we
No. You're done for time? Yeah, we'll discuss it separately.
Okay. All right. Okay, fantastic. That's fine.
We'd like to hear his thoughts.
No, they will be a little radical as always. So one is that, see, in a developing sort of scenario like climate, I'm always worried not that we should never allow great to become the enemy of good. It's going to be a bit of bits and pieces. We will have to build, especially in a developing country like India. US will do, somebody will do. It will be a bits and pieces approach. But even if it's average, you're better off than having nothing at all. I think that's one of the things. Yes, we will not have the NDC how they have done. You may have to do some kind of jugaad and start it off. But the point is, every year we say this, 3 years later we will say we didn't have data because we didn't do something 3 years back. So my view is at some level, we will have to sort of start something. I think that is one. Second, to the point that sort of Dhruva is making, see, I think at this point of time, given where we are from a variety of perspectives, whether it is geopolitical, energy security, all of this, it is impossible for us to do anything which is going to disincentivize hardcore energy heavy emission sector. It's not going to be easy. It's very, very tough. At the same time, is it possible for us to at least begin by creating some kind of incentive or support system for sectors or for companies which are trying to do something over and above the average? And to me, something like this, I agree, Dhruva, that it is not going to bring in sort of fresh capital, but is it possible for us in some fashion to provide some sort of support, to create some sort of a motivation at a structural institutional level, whether it's from government or otherwise, where we are supporting one, people transitioning into more renewable sources of energy, one. Second is in hard to abate sectors, can we look at a situation where people who are trying harder than the average get some kind of support, get some kind of motivation, and it becomes part of something where there could be a pool of capital. I'm not saying it's billions of dollars, but could they possibly get some part of that and hopefully grow it over a period of time? I think these are slightly, and sometimes they may sound a bit outlandish initially, but 10 years later, possibly we may say that, hey, that was something that we could have thought about. I mean, I look back at a lot of the financial market innovation we've gone through, whether it is commercial paper, whether it is some of the things. When they began, they were all very small, but over a period of time, they become part of, over a period, if we are able to showcase that these companies hopefully also generate some reasonable returns, because that data we don't have today, there is a scope for it. But I do think that we will have to look at a situation where we create some pockets of capital which are more easily available to guys like your Monet or whoever else it is, who are trying to do something which is significantly outperforming what their base scenario is.
Fantastic. Thank you, Ramla. With that call to action, thank you everyone participating. Thank you for your views, and thanks to the audience.